Good morning everyone and welcome back to the new video, and in this video we will see credit risk, what is credit risk and what is rating, hazard rate, one Capura models, and how to model risk neutral probability and real world probability, how to use it into this chapter. This chapter will be based on credit risk, and it is chapter number 24 of the book John C. Hull. And let's start without any delay and start credit. The word credit risk mean risk of default from counterparty, right? It is the risk if the counterparty don't or default their payment, agree about payment. So it is a risk faced by other side of counterparty, or if we are a bank, it is a risk faced by our counter. If we are a bank, it is a risk faced by us that if our counterparty default the payment, what is the risk that total exposure of whole transaction is a credit risk. And to define the credit risk, there is a term called credit rating. There are agency like Moody, SMP, SNP, and Fitch. So they have a rating about company or bonds or on bonds. So their rating goes like, the highest rating is for Moody is triple A. First A is capital, rest is small. Then A second, then third will be okay. Third would be A, then B, 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 A, then B, C, and then CAA, CA, and C. Triple A is highest and C is worst. And above BAA, this is called investment grade bonds or investment grade. So the above more, if the credit rating is above BA, the probability of default is very less, and sometimes triple A is considered that it cannot be default. And yeah, and for S&P the rating are same, but all are capitals. In this way, there are credit rating between these, also between investment grade AA and A, that is A plus, A minus, and also for S&P there is A1, A2, A3. So there are many category, and usually rating agency rate the company. Okay, now historical default probability. Prop. So this is the CDF, and we know that CDF function always sort of probability, right? 0 to 1. It is the probability of a default rate. If there is a default, then what is the probability of each till 15 year? So let's say there is a triple A, a triple B bonds, and we want to find the probability of default. So it's in first year it would be 0.16%. It is probability that the transaction bond would be default. And yeah, this is the historical what we say, built with historical data. And similar to that, there is hazard rate. So hazard rate is condition probability of default at t given condition it had has been not default yet. So it is a conditional probability CDF of a transaction where it say that in t, let's say if 3 year, we have to find a conditional probability of 3 year default is 0.78, but this is not correctly, so we will use hazard rate that so that the conditional probability at after 3 years of default, given the condition that the bond haven't been hasn't had not been default yet in 1 year and 2 year, so it is intact or in the money uh, till 3 year, and after 3 year it default, so it is the hazard rate. And it's for there is hazard rate is given by sigma t. Okay, and vt is the total exposure. Okay, vt is cdf of probability of company surviving till time t. Okay, so we will see okay, then we will look at change in probability at very small time, and that would give us delta t minus vt equal to hazard rate upon vt and into delta t. And if we solve it more, this is the derivative part, dvt upon dt equal to minus lambda tvt. And after that we can find the cdf is integration over t lambda tau upon t tau, and tau is 3 minus 1 sorry, tn minus t. Yeah, from that we can find the probability of default. That would be easy. So probability of default would be, it is surviving, so it will be -1. If qt if qt equal to 1 minus e minus mu 0 t lambda tau dt. Okay, and this is also called as a default intensity. Now let's introduce a concept of recovery rate. So if there is a default, so recovery rate is total amount of percentage of amount of original transaction we can recover after the default. So it is total percentage of initial exposure to be returned. So it is generally 40%. And if credit what we said default if wait a minute. Okay, so recovery rate and default rate. So if default rate is low, if default rate is low, there are risk company that is having a default or going under default, so the recovery rate would be more. It is inversely proportional to it. So if there is a default rate is less, then the recovery would be more. It can be up to 60% also. And if default rate is more, then recovery would have a dominoes effect, like a dominoes effect, and the recovery rate would be low, and it can go down to 30% too. That's what I want to say. And there is a formula or a relationship between credit spread. So credit spread have the risk premium of default. So what is risk premium of default? So there is a bid ask price quote, right? if if let's say bid is maximum, a buyer a maximum buyer can bid to buy, and ask is bid sorry ask is minimum a seller want. Let's say if company has less rating, or let's say lower rating, then the buyer, the asking would be low and bid would be low. There would be different between very gap between the bid ask spread because of the credit rating. The company would not bid so much, and asking price of a company could be more, because to sell, a seller want more, right? And that's the bid ask spread or credit spread. Okay, and for a yield, bond yield, it would be more. So let's say our spread would be ST, and our recovery rate would be R is our recovery. So our recovery rate would be this total amount we can recover. So our formula gives us lambda T 1 minus R equal to spread. So our spread can be defined in this term. And yeah, that's the logic behind it. Now let's talk about matching bond price. Right, bootstrap method for yield curve of zero coupon bond. We can use this method to find hazard rate of bonds of different maturity. So it is explained simple in here. So we simply the market price and the risk neutral price would be different, because the default probability, the recovery rate, right, uh, recovery rate and default probability is included between it. Like market price is 0.01 and risk neutral price is 0.2. So the difference between these is hazard rate, is used to find the hazard rate, and it is done like this. If the risk free rate is 5% and we have bond of 1-2 year, and all pay 8% coupon, then the market price of, we know the market price earlier is this, and the risk free rate is this, and default loss is given here. And by using this formula, and this formula is just 1 minus 1 minus 5, this is maturity into lambda. We have to find lambda using solver, excel solver or python. Lambda equal to, that is 100 minus recovery rate, 40%, $40 is recovery rate, and here 100 minus recovery rate equal to 1.5. We have to find the value of lambda such that it is 1.5, and in this way we can find the lambda. That is 2 point, lambda value is 2.46, and that's the hazard rate for a bond. Now let's talk about risk free rate. So generally treasury rate, or rate of bond, government bond, that is treasury bond, is considered as a risk-free rate, and we know what is the risk-free rate, so we will not discuss this. And now comparison of default estimation. Comparison of default probab estimation. So the hazard rate from historical data is always less than hazard rate from bond spread. So why is this the case? So why? This is because, so during the during the 2008 crisis, there was fight for quality, fight to quality. So every investor wanted to be safe, right? Because market was crashing, wanted to save. So they were buying treasury bond, and because of treasury bond, the price is spread increased, and that led to increased in default spread, right? Credit spread, default spread, and this is the main reason. And this is the Moody data analysis of 15-year, I guess. And you can always observe that the hazard rate, historical hazard rate, is very low than the hazard rate from bond that we occur by bootstrapping method or matching the bonds method. You can see it is almost bigger in every case and for every quality of bond, and there is a difference, large difference. And this is given by equation, 7-year bond equation is given lambda 7 equal to -1 upon 7 log upon 1 minus CDF of 7. Okay, and if we put this value, then you get the hazard rate of that year. And in this table you can see the excess return, the difference between the hazard rate from bond and from historical data, and you can see the difference, and you can use this to say how much bias point is excess from the return. That would be great. That would be expected excess return. Yeah. Now let's cover real world probability versus risk neutral probability. We know that our risk neutral probability is always more than real world probability, and we discuss why, right? We can see that risk neutral probability excess return is more, and the reason is that's simple, because of risk premium. Because of simple risk premium, it is like uh, asking why corporate bond return are more than treasury bond, and because of systematic risk also. The the meaning of systematic is things like there is a ripple effect. I mean, if one bond fail and the amount of bond are big, then there is a dominoes effect, then other bond will also fail, and it is like tranches, like CDS sorry, mortgage. Yeah, if AAA fail, then all the tranches will also fail, and this cause a ripple effect, and that's why def, the what we say default independently. This is because of default independently of each other, right? And this is called as a credit contagion. Okay. So here is a question. So which probability we should use? So for risk management or VAR, we use or historical or real world probability. And for pricing exposure, for pricing, we use risk neutral world probability. And now there is a model building approach to how to find hazard rate or default probability. And one is extension of Melton formula, and where VO is a value of company asset today, VT value of company asset at T, EO value of equity today, ET of equity at T, and we have D, that is important, debt repayment due at T, and we have sigma V and sigma E, volatility of asset constant, volatility of asset that is constant, and we have instantaneous volatility of equity. So here we consider that the default is like option. There we ET, the equity equal to maximum of Vt minus D equal to 0, where if our debt is more than value of company, there will be default, and if our wealth is value of portfolio is more than debt, then there will be no default, and its value would be Vt minus D equation value. So our final equation is this, and if we apply Melton formula and treat it as a option, then our formula equal to E0 equal to V0 and D1 minus DE minus ERT, RT and dot and D2, where D1 equal to log of VO upon D plus R sigma square V upon 2T. Simple Black-Scholes formula. That's our BS formula, and so our value of debt will be today would be V0 minus equity 0, and company default and risk neutral probability of company will default is n minus D2. That's the hazard rate or risk neutral probability. Okay, and now we have to find the V0. The thing is, rest is observed from market. V0 and sigma V can be observed from market. Okay, so this can't be observed from market, rest can be observed from market. But so if we apply ito-lemma to our equation, then our final equation, this, if we apply ito-lemma to this, then our equation tend to be rate of change of E with respect to partial derivative of V upon volatility of V0 today equal to n D1 root V dot V0. I will write it properly. And D1 root V dot V0. That's our expression, right? And we can find because of this we can find our value of V0 and sigma V, and so we know the risk neutral default probability as minus V2 is used. Now let's go to credit risk in derivative transaction. In chapter 2, in chapter 1, I guess we care of buy retreat clearing, right? If the transaction is between two counterparty and they clear directly, so they post initial margin or collateral of that cover loss of 10-day, generally 10-day period with 99% of confidence interval. That we are 99% confidence interval, our loss would be this much, and this would be not more than this much, and this would be our collateral, like bar, right? And after event of default. If event of default occurs, the other party would capture or take took the collateral in their hand and sell it for a profit, and if they have a profit. So if total value of transaction to non-defaulting party is in positive, then collateral posted default party, then non-default party, then the non-default party return is unsecured for value of transaction minus collateral. So it says that if the total value of transaction to a non-defaulting party is positive, so there is cash flow in their side, the cash is positive, and greater than the collateral if the cash flow is not posted, there is no posted for positive cash flow, then the loss would be that cash flow. In unsecured editor, then the value of transaction would be value of transaction minus collateral, that would be. And second, then if total value of transaction is positive to default party, then the collateral posted by non-defaulting party is greater value, and then non-defaulting party is unsecured creditor for return of excess collateral posted. So this means that the party B, non-defaulting party B, is in profit, and let's say party A is supposed to make payment, but they default, the defaulting party default, then the excess collateral is put, that is, let's say 20 rupees, and the transaction was of 10 rupees, then extra 10 rupees is needed by the party of default. Okay, that's the main logic. And CVA and DVA, we looked at what is CVA and DVA. Credit valuation adjustment and debt valuation adjustment. This is done for probability of, to ensure the CVA counterparty is for counterparty present value of expected cost flow. Okay, so probability of counterparty default, and we add the DVA is probability of we defaulting as a we defaulting our own default. So final FND, if FND is a risk neutral pricing of derivative, then minus probability adjustment with probability of defaulting for counterparty plus our probability of defaulting, that gives us our fair value of price with all probability included. And right, that it's simple. CVA. So CVA formula is n raised to I equal to 1. QI is probability of default, and VI is exposure. VI is exposure, right? Right. VI is present value of expected loss to bank. Expected loss to bank if default. right? And DBA is same, QI star, that is probability of V defaulting, and VI total probability, total exposure to a counterparty if we default. Okay, and that's simple. By some readjustment, okay, so by readjustment with credit spread and recovery rate, we can derive our new formula where QI equal to exponent of STI minus previous credit spread upon 1 minus recovery rate minus exponent of current default rate. Another approach to find VI, the value of a transaction, is assuming no collateral is posted, and then performing Monte Carlo for finding expectation of every part, every scenario, and then finding expectation and then discounting it. And in this way you can find the value of future cash flow, and then you can minus the exposure. The thing is, you can see in this file where it is. The thing is, first you find the random and then you find the exposure, and exposure is maximum of V and 0, and exposure is calculated like total value of transaction minus recovery rate, right? And then if the V is negative, then the exposure is 0. If V is positive, then exposure is the amount, and the expected exposure is average of all exposure across all MC trial, and then present value of exposure is 1 minus recovery rate that I told you. And then second type is, if there is a collateral posted, then there is a buffer time 10 or 20 days to assume that counterparty stops sending the collateral, or you also assume that they don't return your extra collateral. So we perform the Monte Carlo path till t minus c, and then we find the expected present value of expected loss based on the collateral margin. And in this way we can find the V star, that is total value of exposure, reverse of counterparty, and this helping CVA adjustment. Okay, now let's go to another topic. So if 97.5% is asked for CVA, then it means that to calculate 250 highest exposure and finding the mean of it. And in this way the CVA and DVA, but we can do the same for DVA, and usually we store it. And yeah, now let's netting effect in Monte Carlo simulation, or that is also called credit risk mitigation. So let's say if we are consuming that the bank have a individual transaction of 10 million plus $10 million plus 30 million and minus 25 million, uh, and regardless of any transaction cost, then our exposure would be 40 million, because we wouldn't receive, if we default we wouldn't receive $40 million. And if there is a netting effect, let's say we take this as a single portfolio, then our total exposure would be 15 million, and that is way less than a single portfolio, and that's the credit risk mitigation. And it have a downgrade trigger. Let's say if you are a bank you have a transaction with multiple banks, and for some reason our collateral, the good rating bank doesn't need as much as collateral to put. So if our rating is down, then there is a collateral call. Every bank will bank will add the extra collateral because their ranking gone down, and this would make the bank corrupt, and this is the downgrade trigger. Downgrade trigger. Okay. Right. Okay, let's go to Gaussian Kapura model, and I have a chat GPT, so you have to understand some basic. So we have to, the goal is to find the credit risk modeling time to default the entity is tau is the time, and we have to find the default. Okay, the correlation between two company and company B. We have to find the correlation between the different, and then we assume that every company have a marginal distribution, that is FT, and these are the marginal distribution, and you can see marginal distribution like this. So so the marginal distribution is total number of distribution of every variable. So you have to understand it, and the marginal distribution FT, and the joint distribution. We have to find the convert the marginal distribution into joint distribution upon two company, because two company have a different default rate. So we have a distribution of each as a marginal distribution. Then we have to convert it into a joint distribution using Gaussian Kapila model. And here the joint distribution have a probability of this, where T1 is greater than equal to tau, and T2 is greater than equal to tau. Okay, and Kapura ring the marginal into joint distribution, and you can uh, bivariate normal distribution or a joint distribution. See, bivariate normal distribution is this, between two distribution you have a distribution, and I mean uh, normal distribution, that we want joint normal distribution. It is same, you can see it is same. So we have to calculate a function that combine marginal distribution to form a joint distribution. It is a formula, and ft is so our formula is this, and where f1 and f2 is a marginal CDF, and C is a copula, and f is a joint distribution. And our model work like this: you have a UI, you convert UI into normal distribution, and the method of converting this is u equal to ny upon v, and v equal to n upon u. And in this way, you convert the distribution into this uniform distribution. Okay, then map this to a normal space, and our formula is this, and zi equal to CDF upon ui, or CDF upon ui, that z belong to normal distribution. Or you can rewrite it as a xi x1 equal to n minus 1 upon q1 upon t1. Okay, and q1 and q1 is CDF between CDF for t1 and t1 and t2, and q2 is for t2. And you link it, and then model dependency using multivariate Gaussian, and then we derive z1 z2 from normal distribution. And this is correlation matrix between the default, and we have C equal to correlation matrix upon CDF upon u1 and cu2, and this way we link a marginal distribution into joint distribution and generate a multivariate normal vector. And so we can simulate generate normal vector z, convert z1 into uniform, and use inverse of CDF to find the joint dependency of this. And in this way it work. Okay, I hope you understand it. And next is factor based correlation structure. Factor based correlation structure. So in this we use Gaussian Kapura one factor model, and our assumption are xi equal to aif plus root 1 minus a square I zi, where f is a common factor. F is a common factor affecting uh, affecting the default correlation matrix. You can think, right? Company or company, and zi is factor affecting only one company. And we have zi is from independent standard normal distribution, right? And xi xj, the correlation between x1 and xj is given by ai and aj. Okay, in this ai and aj. And suppose the company will default at particular time. Probability of company default at particular time is qit. You under Gaussian Kapura model, default happen where n x is greater than, probability of default is greater than nxi. Okay, and so our final formula would be if zi equal to sorry, that gives us our nx. We have nx as aif plus root 1 minus a square zi is greater than inverse of ni 1 upon qit, and zi is greater than ni minus qit minus af. Okay, 1 minus a square root b. And if we condition on a value of factor, we condition it on a value of factor f, the probability of default is qit upon f equal to n I minus. And if we consider qi upon t equal to qt for all I, and ai equal to correlation matrix, so our final value would be probability at time t under factor this gives us inverse of CDF minus correlation 1 minus p. Okay, and you can also use this to find credited var, and it is var value at risk for credit risk, that we are 99% sure that in 1 year our credit loss would not exceed x amount. So it in certain way we can say that we are x% certain that value will be greater than 1 minus 1 minus x and equal to minus n minus x. So we can use our one factor model, Gaussian model, because we are conditioning it on our factor this, and we are conditioning on our factor n equal to n minus 1 qt plus correlation. One minus p, and think in this way you can find the var. Then you can find the percentile value into percentile. Okay, you can find var by using one factor model. And let's see what is credit matrix. I think we covered all, only credit matrix is remaining. So in simple way, it is a Monte Carlo simulation of scenario where credit rating is changed. Okay, it determines credit rating change and default counterparty during rate. Credit rating change and default probability. So it is done like we build joint distribution of different credit. We will join distribution of rating change like we did in our Kapura model and find the transaction probability of changing it. So our, let's say, since we know that A company XB, A company changed into BB company, rating dropped to AA to triple B, and our change in variable XA to XB. Then our, since we know there is a table given, you can see that the transaction matrix table. Let me show you transaction matrix table in the book. Where is a transaction matrix table? So you can see the transaction between A, triple A is 89. So we find the default probability for that 893, that is 1.2719. And if A stays AA, and that would be XA would greater than 1.2719, that is the value 1.27. If it is between this, then it stay AA if the value satisfy this condition, and if 0.8983 transition into triple A, AAA transition into double A. So our transaction matrix would be this. If we transaction into this 9375, that equal to 2.4089, and our new condition become it stay AAA if it's between 1.2719 greater than XA greater than 2.4, that is 2.48. Yeah, 2.408. And this way you can find the transaction the new probability of default if the rating has been changed. And this was such a big video and very hard to explain, and I hope you understand it, and I tried my best to cover as much as possible. I am tired as much, I don't know why it took so much time to record this. I am recording this till it from 4 hours. So I I will see you in next video. Bye bye. Thank you for watching.